Hello and welcome to today's episode of Modesty's Money Masterclass. This is episode number 29 and we are continuing on our personal and family protection fundamentals series. This is part 4 of this series, and today we are going to be talking about something very, very important and essential to anyone who's got an income. So if you've got an income, whether you're self-employed or you're employed, today's topic is going to be of special significance and importance to you. So I would urge you to pay very good attention to what we're going to talk about today, because it will prove very, very useful to you later. So I remain your man, Ikenna Umezudike, bringing you this financial educational series every Monday live on Facebook. And remember, the aim here is to help every single one of us on our journey towards financial freedom, and to educate ourselves, help ourselves, and elevate ourselves as much as possible. So today we are going to be talking about income protection. Income protection is what we are going to be deliberating on today in this series of personal and family protection fundamentals. So what exactly is income protection? And that's why I said, if you've got an income, whether you are employed or self-employed, today's topic is of significance and importance to you. So pay very good attention to it, because you may have heard of income protection, you may not even have heard of it. But whether or not you've heard of it, if you haven't got any of it, pay particular attention to what we're going to say today. And even if you've got it, pay attention as well, so that you know whether it needs reviewing or whether it needs looking at once again. So what is income protection? Income protection, basically, it used to be known as permanent health insurance, but now it's known as income protection. It is a kind of insurance policy that protects you against loss of income as a result of illness, accidents, or in some cases unemployment. So that's why it's called income protection. What does it do? It pays out an agreed sum on monthly basis, or on any whatever regular basis you've agreed with your insurer. On that basis, when any of those risks occur, work due to illness or accidents, or in some cases redundancies, but I'm going to come to that later on. Okay, so basically that is what income protection does. It's an insurance policy that you take to protect your income, so that if you lose that income because you can't work, because you're either ill or you're injured, that insurance policy kicks in immediately and offers you an income until you're able to get back to work, or until you retire, or until you die, whatever the circumstance is, and whichever one occurs first. And depending on how long you arrange the policy for, or what are the circumstances around that policy. Now, most of the income protection policies that we know do not pay out on redundancies. A lot of them don't pay out on redundancies, although there are certain specific policies that also take care of redundancies if you lose your job, if you're unemployed or something like that. But those cases are limited as well. But most of the income protection policies are arranged on the basis of being out of work due to illness, or accidents, or injury, basically. So that injury could be through accidents. Now, this is different from critical illness. Remember, we discussed critical illness cover last week. So the difference between this and critical illness cover is that income protection pays out on regular basis, but critical illness cover pays out in lump sum, pays out a lump sum to you. So if you are out of work due to illness or accidents or injury, income protection pays you an agreed sum every month. Basically, every time you're supposed to receive your income, that is when that income protection comes in and pays you an income on that basis to take care of your everyday living costs until you're able to get back to work. So sometimes it's also referred as accident, sickness, and unemployment cover, as we normally call it. And then there is something very unique about the income protection. It's called deferment period. Deferment period is basically a period that you have set by yourself in conjunction with your insurer on when that insurance should start paying out. Say if you're off work due to illness or you can tell your insurer, please do not start paying me until after 4 weeks, 8 weeks, or 12 weeks, or however long you want to defer it for. So the longer you defer your benefits, the cheaper your policy is. That is the way it works. But it doesn't necessarily mean that because of that, you should then seek to defer your policy forever because you want to. It has to be in conjunction with what works best for you. So you can choose your deferment period. It affects your premium because the longer it is, the cheaper your premium generally. You can also choose to receive your payouts at incremental levels. So if you choose to receive your payout at incremental levels, it simply means that you're telling your insurers to factor in, inflation or any other indices you wish to factor in while deciding what to pay you out, whatever the risk occurs. Because, for example, if you take out that policy now and you happen to fall ill in the next 5 years or 6 years, and then that policy kicks in, whatever you've agreed with the insurer or the policy provider to be your payout is what they're going to pay you out in that 6 years' time. Meanwhile, in 6 years' time, a lot has already happened. Yeah, inflation, price of goods have gone up. So your standard of living or your living costs might have increased. Whatever payout you're going to receive at that time may not be commensurate with the cost of living at that time. So some people just say, please increase this payout by a certain percentage every year, or by tracking inflation. By whatever pace inflation increases, increase my payout by then. So it could be incremental, it could be level, or however you wish to operate that. Okay, and you can now use those payments made to you to sustain your daily living costs, pay your bills, pay your mortgages, pay your house rents, whatever your daily living costs are, which normally your income covers. That is what your income protection should be able to take care of for you. Now, payouts for income protection is usually a percentage of your income, not always 100% of it. Say, for example, you earn £2,000, you take home £2,000 a month in income or in wages. If you take out an income protection, that £2,000 a month, the insurer or the policy holder, the policy provider might decide to say, okay, we're going to pay you 70% of your income if you are off work due to illness or accidents or injury. So usually income protection pays out a fraction, a percentage of your income, like 70%. 70% is the most common one. 70% of your income is paid out by the insurer if any of those risks occur. So it doesn't normally always cover 100% of it. So, but 70% of your income normally takes care of quite a significant part of your living cost, and then the other 30% you might find a way to cover that up if you've got other means, but at least you've got a percentage of your income covered if the worst should happen and you are off work due to illness or accidents or injury. Okay, now there are certain areas that are covered by income protection, like accidents, sickness, and unemployment. You can actually structure your policy to cover one or more or all of those aspects, to cover either accidents, to cover either injury, or to cover unemployment. You can structure your policy to cover one or more or all of it if you want, depending on what your priorities are. But most commonly, accidents and injuries are the most common ones that are normally covered. A few other providers take care of unemployment cover as well, if you wish to add unemployment cover to it. But most commonly, accidents and injuries are the most common features that are covered by income protection. Buchi, welcome on board. I can see you. So now, why income protection? Why do we even bother about income protection? Now, do you know that only a handful of employers do take care of their employees for more than 1 year if they are off work due to illness? That should get you thinking. And then after that 1 year, what happens? It means those employees are on their own. So when you are employed by your employer, how many of us normally take time to actually study their employment contracts to see what provisions are made for when they are off work due to illness? How long can your employer support you when you are off work due to illness or when you sustain an injury that makes you unable to work? Do you really take time to study that? And if you have, do you know how long you're going to get that support for and how much? Some employment contracts provides for full pay for a certain number of months, maybe maximum of 6 months. Some can guarantee you full pay for up to 1 year, fine. Some can give you full pay for 3 months, and after 3 months they start paying you half pay, and then all of a sudden it fizzles out maybe after the 6 months. So different employment provisions, different provisions are made in certain employment contracts. Now that should get you thinking. Whatever your employer has provided for you, what if that injury or that accident or that illness renders you incapacitated and unable to work for more than a year or for longer than the period that your employer can guarantee? If your employer can guarantee to provide for you for 6 months, what if you're ill for more than 6 months? It then means after 6 months you're on your own. So that is where income protection comes into play. Now, in the UK here, there are state benefits as well that people do get, when they are off work or when they are unemployed or when they are off work due to illness or injury. There is something called statutory sick pay. Yeah. Now, statutory sick pay in the UK usually, on average, is about £94.25 every week. Okay. So, assuming you have no provision by your employer to pay you anything when you are off work due to illness or injury, then you have to rely on the statutory sick pay, which the government guarantees you if you are working and you can prove your income. How many of us can actually survive on £94 a week in this country, in this UK, if you are off work due to illness? And then how long can you guarantee that that illness will last? So those are the things that you cannot control. And as long as you cannot control them, why don't you take care of the things that you can control first, which is taking out an income protection policy to cover yourself for what the government, the states, or your employers cannot cover, and for the length of time that they cannot cover it. Now, there is an organization here called WHICH, WHICH, which.co.uk. They carried out a survey, and Oluchukwu, welcome, I can see you. They carried out a survey, and the survey report shows that only 9% of the workforce in the UK that they surveyed actually have a provision for income protection. Okay, about 41% said they have life insurance, and about 16% said they have private health insurance. It's amazing that only 9% of the workforce that was surveyed said they had income protection. And these are people who have got income. If you've got an income that pays your mortgage or your rent, pays for all your other insurances like house insurance and car insurance, pays for your children's expenditures and childcare expenses, pays for cost of food and heating and electricity in your house, and takes care of all that. And then you have you have an insurance policy that protects your car, an insurance policy that protects your house. Some even have insurance policies. Some even have an insurance policy that protects their gadgets like their phones or their tablets. But then they don't bother covering the income that pays for those other policies that they pay for. Staggering, isn't it? Okay? So if you have insurance policies protecting all these things around you, meanwhile, the very income that takes care of all those, that even pays for that policy, is unprotected. What do you think is going to happen to those policies when that income dries up, when that income stops, when that income stops coming in? If you haven't got that income protected, you have got nothing protected. All right? But, you know, a lot of people who have got income do not consider this an important aspect of their personal and family protection. They don't even know that it exists. Some people don't even know that income protection exists, and which is why I am doing this, to bring this knowledge to the forefront and to make you realize how much of a risk it is and why important that you cover that risk. So this simply shows a very big hole in the coverage ratio of very important protection policy in the UK. If only 9% of workforce that was surveyed showed that they had income protection, that is worrying. Which is why a lot of when they get sick or when they get injured and they can't work, they really struggle, because there is no other place that the income can be coming from, and you can't completely rely on external parties. And then a lot of them now resort to going to food banks and, you know, living on handouts and depending on other people. When you had, and some of these people you see had very well-paid jobs, and then one paycheck away from crashing everything because you did not prepare for the rainy day. Now, illness and injuries, a fact and part of life. It's a risk that is very possible that you could get sick, you could get injured. You might sleep in your bathroom where you're showering and then twist your ankle or twist your leg, and then you are unable to work. And what happens then? You might fall down the stairs and break your arm or break your hand. And what happens then if you cannot work? I mean, these things do happen. You might just fall ill all of a sudden and you have no way you can go to work because you are not well. And nobody is blaming you that you're ill, and nobody is blaming you that you're injured. But where you've got to blame yourself is when that happens and you have made no provisions for your income to be protected before that incident happened. That's where you blame yourself. Okay, now when you take on statutory sick pay, when you get sick and you haven't got any provisions by your employer, and you're on statutory sick pay in the UK for £94.25 every week, that's about, you know, roughly £400 a month. It hardly covers people's rents in this country on monthly basis. So if you have that statutory sick pay that can barely feed you, what happens to your loans and credit cards that you have to pay back for? If you have a car finance, what happens to that? You cannot pay for it. If you have rent to pay or mortgage to pay and you cannot pay, what happens to that? What happens to heating and electricity? What happens to your water bills? What happens to childcare costs? What happens to the cost of clothing? You cannot even entertain yourself or your family. I mean, your life completely crumbles right before you because you were unprepared for it. So income protection basically takes care of your daily living costs and bills on monthly basis because you are unable to work due to illness or injury. Now, in choosing the right cover, what do you have to consider? First of all, you have to consider your existing provisions. What have I got? You check your savings. How much have you got in savings? Check your employment contract. What does your employment contract say? If you're not sure, talk to your HR or to your manager, or look at your employment contract and see what are the provisions for sick pay in your employment contract. How long will your employer support you if you are off work due to illness or injury? And factor that into the design of your income protection policy when you're taking that out, right? When you factor that in, that will tell you how long you can live on your savings and other income sources that you have. How long would those things sustain you, assuming you're unable to work? Find out how long that can sustain you, assuming you're unable to work. Femi, welcome. Assuming you are unable to work, find out how long that can sustain you, because it gives you an indication of what your deferment period should look like when you are arranging your income protection. Now, I've talked about deferment period when I was, at the beginning, and I want to now, focus more on this deferment period to actually tell you how you can determine your deferment period. Now, normally, the longer your deferment period, the cheaper your policy, your income protection policy. But I said earlier on that shouldn't be the driving factor, the driving force in determining what your deferment period should be. Because if, for example, your employer can only support you for 3 months on full pay when you're off work due to illness or injury, what happens after those 3 months? So it simply means that if you look at what your employer can provide you, then you can also look at how much savings you've got. If you've got savings that can last you for another 3 months, that gives you 6 months of taking care of yourself if you are either ill or injured, right? So you can now say, okay, based on that, and if you have other sources of income that you can live on, how long can you live on those income? So if you think that for the next 6 months I should be fine if I fall ill or if I get injured, you can take your deferment period to be 6 months, and then you say to the insurer, look, don't pay me anything from this protection until after 6 months, because for the first 6 months of my illness or injury, I can look after myself, but after that, I'm really going to struggle. So your income protection will kick in 6 months after you've fallen ill or you got injured. If you think you can survive on your existing arrangements for more than 6 months, maybe for 9 months, you can defer it to up to 9 months. The longer you defer it, the cheaper your premium. But again, make sure that deferment period is realistic and it represents your circumstances or your situation, not just because you want to get the cheapest policy. Okay, and now when you have checked all this and you have determined your deferment period, and you have considered your savings and other sources of income, and you have also determined how long those can last you. The other thing you have to consider as well is, for how long do I need this? Yeah, Chidebere, welcome. For how long do I need this income protection? Now, income protection can last you on. You can arrange it for until you retire, or until you're able to get back to work, or even until you die. Whichever one happens first, or for however long you've arranged it. There are short-term and long-term income protection policies that you can arrange. Some short-term policies exist and they are cheaper. Those ones can pay you out for between just 1 to 5 years. All right. For example, if you're on a contract, job, and your contract is for 2 years, for example, and you want to make sure that within those 2 years, if sickness or injury stops you from executing that contract job, that you still want your income to be, coming in, you can arrange an income protection for 2 years, because that's actually when you need it for. You don't need it for longer than 2 years. Now, after that 2 years and you've renewed your contract, you can renew your policy again and arrange it for as long as your contract lasts again. Right, because your employment or your income is time bound within that period. So arrange the policy to be within that time where you need it. Now, if your income is not time bound, and maybe you're just a full-time employee working for a company, it makes sense for you to arrange an income protection that can last you up until retirement, or for however long it takes before you retire. And once you arrange it, if you arrange it on a level term, it means the premium will remain level throughout the duration of that policy. So however long that policy lasts, what you're paying today is what you continue paying for however long the policy lasts. Joy, you're welcome. And when you arrange it on that basis, it gives you that peace of mind, and then you carry on doing what you're doing, because you know that up until retirement, your income is protected. Now, bear in mind that a lot of insurers and a lot of policy providers do not offer you income protection if you're less than 5 years from retirement. A lot of policy providers will not offer you protection if you are less than 5 years from retirement. So you work out when your retirement is and for how long you need, and you can arrange it for until retirement. So it tells me that at any point before retirement, if you are off sick, that protection can kick in. And if that sickness means you can never work again until you retire, that income protection will keep paying you until you retire, or for however long you have arranged it for. So it makes a lot of sense for you to get that level of protection if you have any kind of income at all. Now, certain exclusions, although, do apply for certain job specifications or certain professions, which is why you've got to speak to an advisor or speak to your advisor or somebody who has access to the whole of market, like we do. When we arrange income protection for individuals, we do not work for specific providers because we have access to the whole providers in the marketplace. So we basically look out for which provider is providing the product that best matches your circumstance and your situation, and we recommend that for you. I just arranged income protection for one of my clients a couple of weeks ago, and it was until retirement for him. And then when we were choosing the provider, we took into consideration providers that have good reputation for paying out claims and providers that provide favorable conditions that will enable flexibility in that policy while the policy is on. And then we also take into consideration the client's individual circumstances before we recommend it. So if you haven't got that much of an idea of how best to arrange income protection, speak to an advisor. We don't even charge for that service, for that advice. That is even the beauty of it. If you're coming for protection advice or protection consulting, we don't even charge you anything. We provide that advice because the policy providers or the insurers, they remunerate us for the job we do. But we represent the client and not the policy providers or the insurers. But speak to an advisor because it makes sense for you to get quality advice before you choose your income protection. And you've got to trust your advisor if you speak to them and trust their recommendation. Now, in this COVID-19, it's important for you to know some of the changes that have occurred because of, this coronavirus, because this has to do with illness and injuries and all that. So as you would imagine, a lot of insurers have, made some adjustments and some changes because of COVID-19. So I'm just going to give you a quick rundown of some of those few changes. I'm not going to mention those insurers because, this is, I'm not here to discuss individual policy providers. I'm just here to give you a general blanket information. Now, so all insurers actually stopped offering unemployment cover since the 19th of March due to COVID-19 situation. Obviously, people are now being furloughed and all that. So a lot of insurers stopped offering unemployment. People are losing their jobs. They stopped offering unemployment cover since the 19th of March. So as at 28th of April, according to which.co.uk, that decision is yet to be reversed. So insurers are still not offering unemployment cover at this moment as at 28th of April when this website last checked. And then some insurers are still offering accident and sickness cover, but they have added some restrictions to the cover that they provide, obviously because of what's going on around the world. There are a lot of health concerns now due to COVID-19. Now, some restrictions have also been placed on applicants that might have coronavirus or coronavirus-related based claims. Some coronavirus-based claims are really being put into serious scrutiny, and a lot of insurers have excluded coronavirus-based or related claims from their list of situations that they pay out claims on. So it's very important that we check all this while we arrange income protection for our clients. Now, some providers have also, as a result of this, increased the length of time that the policyholders will have to wait until they start getting their payout. In essence, they have increased the minimum deferment period that policy holders should have with them. So these are some of the few changes that have come in as a result of COVID-19 in relation to income protection. Okay, so this is where we're going to hang it up today, folks, and I hope today's session has been useful to you, and I hope I've been able to help you in some way and make you understand the importance of income protection. And if you haven't got income protection and you have got income, please give it a serious thought and a serious consideration. And if you need my help in any way, shape or form to arrange this for you, or to look at it, to look at your existing provision, please feel free to get in touch with me on 07774882126, or go to modestyfinancialconsultants.co.uk and send us your inquiries, and we'll be in touch with you as soon as possible. So on that note, I am your man once again, Ikenna Umezdike, signing out today and wishing you the best of this week. And please stay safe, stay strong, stay healthy, and stay happy. God bless you all. Take care and see you again next week. Bye now.